Hello, I'm Sarah Teacher. I'm Executive Director of the Impact Investing Institute. The Institute is a non-profit with a vision of a capital market that drives a fairer, greener, more resilient future. And it's our mission to accelerate the field of impact investing, both in the UK and internationally. Ultimately, we think that a thriving market that makes investment decisions based on impact, risk, and return across asset classes can be an exemplar for broader capital markets change. So, in short, we're interested in impact investing, where it is currently, the emerging practices on the fringe that through centering impact are interacting with investments in a transformative way, and its current limitations, where it needs to be pushed and changed. And that's the purpose of this session, to explore these three elements. When we situate these three elements in the context of three horizons, we're really looking at Horizon 1. That's where most of investment practice is today, the 98 trillion capital markets, no one considering impact a bit of responsible and sustainable investing. Horizon 2 is where I would situate mainstream impact investing for market rate return and impact. That's innovation that exists today that we should be participating in, the 1.164 trillion global impact investing market. And Horizon 3 is where impact investing ultimately needs to go to power the new impact economy models, to play with risk-return profiles, take bets on new structures, new vehicles, and that currently is a tiny slice of that trillion, and we really need to push and grow it. So to get into these themes, I'm joined by three superb panelists who really sit astride the Horizon 2, Horizon 3. I've got Kunle Apampa from Capricorn. That's Jeff Skoll's family office and now OCIO service, building on a 20-year heritage of investing for commercial returns and impact, a $9 billion platform. Harry Davies from Ceniarth, Diane Eisenberg's family office, deploying catalytic impact investment strategies, taking the entirety of a $700 million portfolio and being active in blended opportunities, taking a catalytic role and playing with that risk-return profile in exchange for impact. And Rasmus Nørgaard, co-founder of NREP, one of Northern Europe's largest real estate investors and developers with 20 billion AUM, who now in his second working life is founder of Home.Earth, a real estate company that design and develop properties with the intention to own and operate them for perpetuity and embodies donor economics. So really challenging and pushing into Horizon 3. So the four of us are going to talk for 30 minutes and have 10 minutes of Q&A. I've got my iPad here. Please get your questions in. These are world leaders in thinking about impact investing, and I'd love you to fire some questions. So we're going to do some quick intros first and say who you are and give me a bit of a shape of the organization you're speaking for. So Kunle first.
Wonderful. Can I get a woo? Can I get a woo? Yeah, let's get that energy level up here. Thank you for the introduction. My name is Kunle Apampa. I lead our client work at Capricorn Investment Group. The origination of Capricorn is the anchor client being Jeff Skoll, who was the first president and first employee of eBay and made a massive amount of wealth when eBay IPO'd in '99. He had one mandate with his capital: don't do it the way everyone else is doing it in the financial space. Figure out a way to still have this in perpetuity, but let it be aligned with his mission, which was very broad and subjective: peace and prosperity for all. How do you do that in the investment world? So we've had over 2 decades of figuring out what that means and finding within the traditional investment space how to actually get attractive commercial capital and keep the pool in perpetuity, but also have it aligned with the things that we really care about in the philanthropic space as well. So that's what I do on a day-to-day, and we'll get more into it in the conversation as well.
Harry, just a quick overview of who you are and Ceniarth.
Yeah, hi everyone. I'm Harry Davies, and who I am is less important. Who I work for, Diane Eisenberg, is most important in terms of what she's chosen to do with her wealth. So Ceniarth is a single family office of Diane Eisenberg. We were founded just over a decade ago now, in 2013, after Diane was the beneficiary of a large generational wealth transfer. We manage about $700 million on her behalf, and the goal is to invest the entirety of that capital base in what we frame as impact-first investments, benefiting marginalized and vulnerable communities globally. I think when we say 100% impact first, probably the one thing that distinguishes a little bit from some other actors in the space is, two things. One, we genuinely mean it, and secondly, I think we've internalized the reality that in some circumstances, not all, there are trade-offs between impact, risk, and return. And so Dan's taken a more progressive view of the asset base, and so we have a sort of lower long-term risk-adjusted return target, and are targeting kind of long-term inflation protection, and nothing more than that.
Fab. And Rasmus, to introduce yourself.
Yeah. Woo! But yeah, I'm sorry I can't be with you, but this is what was possible. But at least I sense I have a very big presence in the room. I'm the only one on the screen. So I'm Danish and have worked as an entrepreneur in the real estate space for more than 20 years now. I was one of the founders of a company called NREP, or Nordic Real Estate Partners, that now has changed its name to Urban Partners. And Urban Partners manages roughly 20 billion today, more than 700 people, has delivered over 18 years in IRR above 20%. And at the same time, I would say has been one of the leaders globally in terms of decarbonization of real estate. I was the CIO there for almost 14 years, and now I sit in the board. But decided to move on a couple of years ago to start a company called Home.Earth. And I think the reason for moving to build a new company is that I wanted to work more holistically with impact, both across the planetary boundaries, but also all the social dimensions. And I think that I felt that required a different business design than a private equity structure. So Home.Earth was launched a few years ago. We capitalized the business roughly a year ago. We are a small business. We're a team of 18 people in Copenhagen and Amsterdam. Right now, we're just investing in Copenhagen, so have 3 properties today, in the process of buying another 2. We're doing our first construction project right now, where we're getting to roughly a carbon footprint of 5 kilos of CO2 per square meter per year. It's the lowest ever achieved in Denmark. It probably doesn't say that much to many of you, but it's a good start. And then back to what you said, Sarah, we've initiated kind of the first donut actually manual for an industry called Donut for Urban Development that we did in collaboration with universities, Donut Economics Action Lab, and so forth.
Fantastic. So you've met our panel and understand the depth of expertise that you can ask questions of. So I can't wait to see my iPad chock full. So we're going to start with some current practices, and I'll turn to you first, Kunle. So in this room, and this whole conference is really situated on criticism of the current financial system. And yet many of us in this room are still invested in very traditional ways. So what could they learn from the work that Capricorn does and the compelling impacts and returns you've been driving?
Yeah, I want to start maybe a little bit, because I know we really want to get into this topic, but we're all in the same boat. I started my career at Goldman. I did the traditional type of investing. I think I was a little bit lucky that at Goldman, we acquired a firm called Imprint Capital, which was really focused on ESG and impact investing. And that was my first taste into the world of sustainability, but deeply integrated into finance and how you can actually build asset management companies that are seeking return first, but also commercial in nature. But also, how do you identify founders and fund managers that are building organizations that are purpose-built from the ground up, which I think 15 years ago did not quite exist. So there's been a bit of an evolution over the last 15, 20 years, particularly in the sustainability space. And I also assume and predict that there would be in the next 15 to 20 years. But I think today, what we can be proud of is that you can actually build 100% mission-aligned, multi-asset class, endowment-style portfolio than you could 15 years ago. And so back then, we had to supplement for a lot of the things that were still done in traditional space to be able to earn the types of returns that we needed. Why are returns very important in the impact space? Because I know that people here are so key on the impact, which you should be as well. But I think a lot of asset owners, like family offices and foundations, they do have operating needs. They do have liquidity needs. They need to pay staff. They need to run a business. They have holdcos. They have subcos. Life still needs to happen. And in order for you to do so, you need capital in perpetuity to be able to maintain the purchasing power of your organization in itself. And so your ability to be able to invest in places that give you the opportunity to do so is very key to building the organization. Now, what we haven't done in the finance space in depth was do an analysis of what is that net impact on every investment you make. Make no doubt, there's impact in any investment you do. It's just that over the years, we've not done a great job measuring what type of impact comes with a lot of the financial investments that we do. And I think all of us in this room, and I can say majority of the impact investment community more broadly, is more keen on finding how can we find that net positive impact in the investments that we're making, and not just assume that the investments that we're making have positive impact in itself. And I think that's what differentiates the traditional investor from the impact investor, is that intentionality of making sure you understand the dynamic nature of the impact that exists within the investments that you're making in itself. And so, look, I'm not here to shame anyone that's in the traditional space doing this work, because I think a lot of us are making that transition from probably haven't been trained or learned in traditional space and now pivot into a space that's more aligned with your core, more aligned with your values, more aligned with your mission. And I think more and more of us should continue to be able to push that needle and also educate folks that there are opportunities to be able to earn that type of return, earn that type of purchasing power for you to be able to build your organization while still staying true to who you are, while still aligning with the things that you value the most, while still aligned with your mission overall. And maybe I'll end on this note. We have a 15-year track record now doing this, not just for Jeff Skoll, but have invited other families and foundations on a selective basis to join the platform. And over the last 10 years, because I can give you a 10-year track record, we've beat the MSCI ACWI, that's just your pure equity market, by about 70 basis points for all our client portfolios on an aggregate level. And then we've beat a blended 60-40 portfolio, which is 60% equity, 40% bond, by about 260 basis points over the last 10 years compounding. So the question is, can you actually find returns in impact? It's really, what are you actually doing to be able to sort of get in, get started, and then start to build on your concentric circles of competencies that you're really good on to be able to advance the space more broadly.
Thank you, Kunle. So if I may shorthand what Kunle's just said, there is no excuse not to be an impact investor amongst the current paradigm. Right now, like Capricorn is doing, you could be delivering the financial performance that you're delivering right now and delivering positive real-world impact. Right, but that's not what this conference is about. This is about pushing further, but baseline, we're impact investing. So Harry, to you, Ceniarth has been on this major journey of change from the market rate return and impact framing that Capricorn embodies to being more fully catalytic. So tell me about that story. Why did that happen? What has it meant for you in practice?
Yeah, thanks. And so we're probably about a decade behind Capricorn in our learning journey, but now have sort of 10 years of experience. So in 2013, we started building a fairly today conventional, but 10 years ago still fairly unusual, sort of best-in-class ESG/sustainable investing portfolio that was heavily weighted to public equities and fixed income, with some sort of slightly more adventurous but commercial investments in the private markets, and then had a carve out to go and do, I guess, what we'd probably all call real impact investing, in the private markets, looking in sort of harder to reach geographies, new sectors. And I think we sort of did those strategies in parallel for about 5 years. And I think over that period, Diane, our founder, and the custodian of our wealth, became increasingly convinced that if your mission is to move all of your assets into helping some of the poorest and most marginalized people in the world, whether they're in the UK, the US, Africa, Asia, Latin America, that not in all circumstances, but in many circumstances, there are trade-offs to be had if you want to reach those people. And the sort of cakeism that, some people, I think, indulge in that, is not always productive. And so I think Diane was in the position that she had a choice to make. There's a subset of what we do that generates commercial risk-adjusted returns, just like what the work Kunle spearheading at Capricorn. And, those investments are still incredibly impactful, but that you have to self-select out of things if that's your strategy. And so, Diane had a vision to do something a bit differently with our asset base, and so we've shifted to what we frame as impact first capital preservation since 2018. And so for us that means a couple of things. So one is a reduced financial goal. So our goal is to cover inflation and expenses over time, so that we can preserve the real value of the asset base and continue to invest it in impact. Obviously, inflation has been higher than expected the last couple of years, but we hope in the long run that means if we can achieve net returns of 4, maybe 5% across the asset base, we don't need more than that. And so that's actually now our optimization function. And then we want to create as much impact as possible within that financial constraint. I think the second shift we've made is a goal to move the entirety of our assets into the private markets. I think there are compelling narratives about shifting the behavior of public markets. I think our view is most real impact investing is happening in the private markets, and we probably don't have the scale to really shift the behavior of public markets. And then the last thing is that, everything we're doing is, in businesses or via funds investing on our behalf in businesses that are, have a very clear theory of change to improve things for people and or planet. So that's sort of the journey we've been on. As part of that, we've experimented with a mixture of kind of more outsourced models and but have landed now in building a kind of bigger internal capacity. And so we're now doing all investments in-house. We're sort of 6 years into this sort of program since 2018. As of the end of last year, we'd deployed $275 million with about another 50 million of unfunded commitments. So we're getting close to 50%, and the goal is to sort of try and get there as quickly as reasonably possible in the next couple of years. Last year was a big sort of momentum shift for us, our biggest year to date from a commitment perspective, and we have a healthy pipeline and sort of growing team to deploy that.
Fantastic. So you're scooting from Horizon 2 into Horizon 3 and capitalizing some of the business models of the future, which brings us on to Rasmus. So Rasmus, in your working life, there are two halves to your story. The first, the extraordinary success in your very high quality urban regen, what I would class as Horizon 2 development work. But now you're in this boundary-breaking Home.Earth space. So tell us what's distinct about the new model that you're driving, and how does it challenge norms of practice? How is it structured, governed, and how does it think about success?
Yeah, and would concur with how you position it in Horizon 2 and 3. I think if I just go back to Horizon 2, I think you say, for us also, we started out wanting to demonstrate that doing good is good business, and I think to a large extent that has worked out well. I still think, though, over time I grew increasingly frustrated with the structures, the financial structures that we're kind of working within. I think they're typically too short term in their nature, and I think at the end of the day, even though we try and design for positive outcomes, at the end of the day, kind of the proceeds of those models typically go to call it the capital and those that manage the capital more so than others. So, and then I would say also in an industry like real estate, but I would expect that happens in a lot of other industries as well. I think the financial structures limits innovation. It puts some boundaries on how much you can drive innovation. So for me, even though it was successful, there was also a frustration and a desire to work with more long-term capital, both to drive innovation, but also to drive positive impact. And especially in our industry, think there's significant scope for doing both. So set out to establish Home.Earth fundamentally with a very different mandate. One where we could drive both innovation and positive impact. So Home.Earth is structured as an evergreen investment vehicle. It's set up as a company, just a normal company. But then we have set up a foundation that creates a mission lock on the company. So the foundation controls the purpose of the company. It doesn't control the company itself, but it controls the purpose and creates effectively a mission lock. Then, and this is more around how we work as a business, we work what I would call integrated across the value chain, and that's more specific to real estate. But I think one of the issues in real estate is that it's a very fragmented industry. And when you're dealing with assets that should be there for 100 plus years, I think you need more of a life cycle perspective on how you do things. So we try and take that approach. We call it design to operate and operate to design, more of a, so you have feedback loops in that and can do things differently. And then finally, I would say we've designed what I would call a true stakeholder model. And this goes a little bit back to who are the beneficiaries, where we try and create both alignment, but also recognize the different parties to what we do. So in our model, 75% of the value creation goes to the investors, 15% goes back to the tenants. So effectively, it's a profit-sharing scheme with the tenants of the business, the customers of the business. And I think what I tell investors is you should not see this just as a cost or leakage, as you would say in financial terms. This is also creating alignment with your tenants, and that will drive a different behavior. It'll enable tenants to be more loyal. They will take better care of things. They will stay longer. We'll have less churn. And for instance, tenant churn in a real estate business is super costly. Then 5% of the value creation goes to the foundation. That will be used for innovation and research around the purpose of the company, so also benefits the company, but also benefits society. And then 5% goes to the team. So the team has also decided to go a different route to traditional private equity structures. We are employees in the company, so there's not a management company. I'm in Urban Partners. I'm still a big shareholder in the management company, and for transparency, have become a wealth holder myself in that regard. But I think when you look at private equity models, and we see a lot of people coming out quite wealthy from those business models, there is scope for what I would call systems change in that regard. So we are employees of that structure, and we have call it a good bonus scheme with the 5%, but that's it. And I think altogether these pieces, which goes back to business design, for me, that is where a lot of the systems change lies. I think we need financial structures that aligns, that recognizes, that distributes value among all the different stakeholders of businesses. And for me, this is, call it the financial systems change piece, I think underlines a lot of the other outcomes that we are, call it desiring. So for me, a lot of the horizon 2 moving from horizon 2 to horizon 3, this is where for me a lot of this is centered.
Really helpful. Thank you so much, Rasmus. So driving these dramatically low carbon developments within the context of a governance model that rigorously locks the long-term purpose of the company. It's really exciting work. So we're going to get into the challenges in the impact investing field and the kind of the limits that we're chafing against next. I've got quite a few questions, but keep them coming in because in about 10 minutes we'll turn to those. So Harry, so far, everything sounded very optimistic, which is kind of my vibe, but still. So while progress is being made, what are some of the barriers that you feel are impeding impact-led investing growing? And I don't know if you want to say a bit about any gatekeepers or incentives that you encounter.
Yeah, and so I think there's sort of different challenges, with different potential asset allocation pools. So I think when you think of more institutional capital, scale is still the number one constraint for pension funds, insurance companies to come into this space, just because of the typical allocation sizes they make. They really need to be investing in billion-dollar impact funds to even look at them, and how many of those exist? A very small number, unfortunately. So that's one part of the market. And then I think when you come on to family offices and foundations, I think there's a different set of problems there that are less structural and more, I think, about sort of incentives and maybe a little bit of inertia and risk aversion. So I guess, as you said, I think the question to me is sort of who are the gatekeepers in these scenarios? So in endowments, it's usually trustees, and in family offices, it may be sort of complex sort of multi-generational decision-making structures. And changing those is hard, right? And the easy thing to do is maintain the status quo, trying to move into what seems a fairly exotic, albeit it's a now pretty established practice, is a hard sell. And I think something I reflect on at Ceniarth is we had an unusual scenario where we had one decision maker with full discretion. And I think it's sort of easy to forget that, but that gave Diane a lot of freedom that other, family offices or people trying to drive change in foundation endowments don't have. And then I think the other issue is when I think of gatekeepers, it's the sort of financial advisory industry. Unfortunately, most people are not sort of mission driven like Capricorn. Most are making lots of money investing in pretty conventional strategies, many of which are within their own funds that they distribute. And the whole sort of incentive alignment of the asset management industry, for people managing, wealth for family offices or endowments is at the moment structured to benefit from to the status quo and not moving assets into different strategies, particularly ones that might have different sort of return expectations. So I think those are some of the big constraints we see in the broader market.
Really helpful. And certainly at the Institute, we've done lots of work on trying to unblock some of these barriers, the kind of the financial system barriers, as well as encourage and support wealth holders and endowments that want to invest in a different way. Rasmus, I wanted to understand, even from the mainstream impact investing community, I think of you, you're a world-leading real estate developer with a pioneering model that's delivering exactly what this community here is talking about. So I expect it's a straightforward race with the impact investing community, or maybe you'd like to give some colour to that.
It's not, but we are moving forward. So I guess that's the positive note. But no, it hasn't been straightforward. I think there's incredible conservatism when it comes to, for example, financial structures. We've gotten so used to to structures looking in a given way, and there's actually not a ton of appetite for innovation on that side. And this is where you could say my background is much more with, call it the institutional investor segment, which is, in some ways, if we should take a positive view of it, in some ways it's very straightforward because it's fairly transactional. There's less, call it emotional elements to it. So kind of you can sit down and have a business meeting, what do people want, etc. With Home.Earth, I've started engaging with the impact investing community and kind of at a, you say, personal level, I really like the community. It feels like it's my crowd. So I feel that's where I can kind of connect with at an emotional and also in terms of, call it, awareness. But I think for me, there's in the impact investing community, if you'll excuse me, I feel there's a little bit of a disconnect. I feel there's more talk than action. I feel capital is moving way slower than it should. And I think in my mind, impact investors should be the most risk willing out there. I mean, given all the different challenges we're facing as society, and I think we all know that there's a multitude of those, I think we need to move capital at scale and urgently. And I just don't see that happening. It feels like, to me, it feels like there's still a fear in terms of actually moving the capital. So mentally, people are there, but when it comes to actually deploying capital, then there is kind of a disconnect. And I would say for Home.Earth, our sweet spot so far has been what I would paraphrase it as saying entrepreneurial people with good values. I think that has been our sweet spot. We have a few that I would who identifies themselves as impact investors, but I think we're also moving forward with institutional capital and would expect within the next year that we'll have some of those. So we'll see how it develops. But at a personal level, I would actually love to mainly have impact investors because I think there's great alignment.
Fantastic. Thank you so much for that, Rasmus. So Kunle, hearing some of the challenges that Rasmus is facing, what are some of your very experienced impact investing yourself and these Horizon 3 type business models? They are a challenge to the norm. What are some of your solutions to the field to get these ideas invested in? What are some of the levers of change?
Yeah, I think Rasmus brought up a really great point. There's a lot of analysis paralysis and people trying to figure out but having the fear of actually doing it. And, I've actually respected the path Diane and Ceniarth have taken. You mentioned started with outsourcing, built the competency, brought it in-house, and were able to then find their own true North Star of what they wanted to do. It didn't start that way, right? There was an evolution, but you have to start. And I think a lot of people just are not starting. And that's the problem, is that we are scared of the failures and scared of showing that, you haven't figured it out yet. Meanwhile, the whole point is to start and then through the failures, learn how to be better at it. Capricorn as an organization, outside of managing full suites of capital or even carve-outs for clients, one of the things that has been very important to our evolution over the last 20 years is this idea of providing not catalytic capital in the sense of blended finance, but catalytic capital in the sense of return first. How do you actually start to seed fund managers today that in 10, 15 years' time can absorb much bigger capital? This idea that you can use asset management as an industry, as a theme in itself, as a catalytic tool for capital to be able to move into the impact space. Because without these big vehicles that can absorb large capital, we're going to be stuck in this very little circle that we're running around, right? And one of the things that we've done over our last 20 years is finding an opportunity to provide not just GP capital, but also anchoring and being one of the first LP capital into some of these ideas that we think are innovative, differentiated, but more importantly, integrated in how you think about returns versus impact in itself. And so we've done this 25 times now over our history, half of it off our balance sheet, before we then realized a lot of our asset owners actually do enjoy not just investing in businesses, but also being business builders in itself, right? And so it's very aligned with the family office who is just very used to building and operating companies, finding asset managers that they can then fund, but also help build up in itself. Generation is, north of 3 billion today. They started in 2004 with, 500K. And, I only know this story because Jeff produced the movie through Participant Media for Al Gore's Inconvenient Truth movie when it came out. And so when Al Gore and David Blood started Generation, Jeff was also one of those first people they called seeking seed capital to be able to do so. And so finding opportunities to co-create, to partner, to create the solution that you want to see, and then seed those asset managers today is what I think folks can start to invest into to sort of build out the ecosystem more broadly so that capital can start moving in massive waves as opposed into smaller.
And there's lots in the Ceniarth story that also chimes with that. So we've got some questions come in, and actually one of the first ones from Melissa Mean is really comes to the heart of this this paradox between these small proofs of possibility, these exciting new models, and the scale that capital often needs. So Melissa says, lots of community asset builders, for example, community-led housing, find that we're viewed as too tiny and too risky for long-term lenders and investors to bother with. How do we change this and get recognized as an investable asset class at a scale that matters? And also, sort of asterisk, we're exploring the idea of mutualizing our assets as a way to reach an investable scale. Is this a good idea? That sounds like a Rasmus question for me. So Rasmus, do you have thoughts on, small scale ideas and how they start to be able to speak to these bigger pools of capital that are intending impact?
Well, you say when you talk about small scale ideas. So one thing that confused me a little bit about the question, but maybe again it goes back to kind of the financial structure. I mean, I would guess housing is probably one of the most scalable investment segments you could find anywhere. So you could say I think there's a ton of scale in whether it's sustainable or inclusive housing. I think if it's kind of community led or it's done in a financial structure that investors cannot see themselves engaged with, then that can be the issue. But more housing as an asset class is, I think super scalable.
To clarify Melissa's question, because it's community-owned housing, similar the struggles with the innovation in your business model. I think it's because the governance is locked in a different way. So the underlying asset is the same, but it's the ownership model that's getting in the way of that scale.
Yeah, I guess it's building the value proposition to investors, I guess, and it seems like if it's owned by the community, the investors can come in as lenders into structures like that, and I don't know if you can. I mean, what kind of return you can provide lenders, but in principle, you should be able to share part of the equity upside with lenders. So you should be able to provide a decent return that should satisfy investors. And then I think, to your point, it goes back to governance. How do you create kind of a sense of that risks on behalf of investors has been taken care of in terms of how the structure has been set up. I don't know that I have specific input specifically to this business model, but I think it should be doable. But it goes back to the value proposition to investors.
Thank you, Rasmus. So a question for either Harry or Kunle. This is from Lucas Bunce. And it's around this concept of the pool in perpetuity, which I think that both of you are manifesting. So Lucas asks, why is it so important for the funds to keep the pool in perpetuity? Is there any thinking about converting some of the financial wealth into other kinds of wealth, given the massive challenges we're facing? So I don't know if you both want to reflect on, you've already touched actually on perpetuity, but...
Yeah, I can start. I think it's a great question, and I think it's one we may confront sort of more thoughtfully when we get to sort of full deployment in a couple of years' time, because even our sort of more flexible financial aspirations create constraints of things we can't do, and we see that every day with really innovative ideas or things that just need sort of huge amounts of risk capital that we're not quite comfortable to provide. I think it's a great question. I guess when I work back from my more pragmatic sort of mindset that, if goal number one is scale the things that are genuinely commercial and get as much money as possible into them, goal two might be, I think Diane's view is like, why wouldn't any ultra high net worth person in the world be happy to just preserve their very unfair amount of wealth in the long run, And so that's maybe a slightly more incremental approach to the more radical views on redistribution of wealth. So,
could I answer that?
Yeah, please, yeah.
I like the question, and maybe I answer it very slightly, which is perpetuity sort of implies, you want to keep it growing for a very long time. And I think there's this aspect of a lot of asset owners have spent years building businesses, working hard, and now made wealth. And they want to enjoy that wealth either for themselves or for generations to come. And I don't think perpetuity in itself is a bad thing, because when I think about the US asset owners, especially foundations, a lot of them can live off of 4 to 6% annual. But now finance has become an industry in itself where everyone's chasing the maximum return in itself. And I think that's where the problem is that you're giving up everything else all in the sake of maximizing return. And that's where a lot of the negative impact comes into play, is because you're not in your diligence process considering factors that are bad before you write that check, or doing that extra analysis to make sure you're comfortable that the end result is the outcome that you want to see. And so I think perpetuity can be good if done in moderation and in context. And I think with asset owners, a lot of asset owners in the US can live, again, from 4 to 6% and don't always have to chase 8% plus every single time from a return profile.
Really helpful. So we've got a last question here from Chris Blues. Hi, Chris Blues. we found Horizon 2 and Horizon 3 really pushes decision makers, particularly investment committees, their ability to perceive risk because it's innovative in Horizon 1. So we've already touched on this, but how can we influence key decision makers to embrace the risk appetite for Horizon 2 and Horizon 3 investments? So, I'm flinging my pen off the side. How can we get that discussion moving and convince and encourage more dynamism and courage from key decision makers? I don't know if any one of you wants to take a go at that, and then we'll move to concluding remarks.
Do you mind repeating it? I may have.
Yeah, so it's really how do we encourage these key decision makers, the gatekeepers that Harry talked about? How do we bring them into this space where they feel emboldened to make the brave choice, the new choice, to step into something that's actually probably pretty commercially compelling, has a great team? How do we overcome that talk-action gap that Rasmus suggested?
I think one thing is...
I can give it a go.
Oh, go for it.
I can give it a go. No, but also connecting to actually the previous question a bit. I think the previous question for me is a little bit, there's this kind of a stewardship angle to it. And I feel kind of the unblocking that needs to take place, I think a lot of that is call it inner work. It goes back to honesty, it goes back to courage, etc. I think you say stewardship as a concept works. I think it's a beautiful concept. It works really well when it comes to land or nature or community or family business. I think it's actually, for me, a terrible concept when it comes to wealth. I think capital is not the end destination. It's a tool. It should be used. I think if you talk about stewardship of wealth, it leads to a certain passiveness. So I'm often struggling a little bit with the notion of preserving capital. I understand kind of the reason why, but I think we're at a time also where we need to activate capital. So I think people should do the inner work to figure out what is it ultimately that they want to achieve. And if preserving capital or maximizing capital it kind of contributes to that, then great. But I think the journey that we need to be on in terms of unlocking further capital needs to be an inner journey. And I think courage is a big part, as the question also had in it.
Really helpful, Rasmus. So we're going to move on to our concluding question, ending with a dose of hope. So I'd like each of our panelists to end with a short response to the below question. So, Kunle, to you first. What gives you hope that we can collectively mobilize more wealth to enable the transition towards futures of human and planetary flourishing? Hope.
I want to start with everybody at this conference, 1. 2, in the context of responding that way, like I said 15 years ago, looks much different than today. What gives me hope is a lot of you in this room are going to be building things that in 15 years to come becomes that pioneering work or pioneering star that you've been able to develop over time as well. I think the human capital element is so huge in the impact space that people underestimate that we still need people to actually build these things and believe that they can build these things. And the more and more I engage with the community, I think I just have more hope that we can actually develop the systems that can absorb more capital into the space so that we can actually change the narrative.
Really nice. So this room is giving Kunle hope. Harry, what's giving you hope?
I guess to build it, I think the human capital point again, and I think it's funny to reflect, I'm now nearly 40, so no longer young, and but the generation...
Yes, you are, Harry.
Generations below us, like people are going into impact, whether it's from a more philanthropic or systems perspective or as an investor, like people don't want to go and work at Goldman for 10 years anymore unless it's an impact. And I think that human capital shift is going to be really meaningful, and we see it in the market. And then I think the second thing I just add is, like this sort of, like there is so much evidence and a lot of very transparent actors like us and Capricorn out there showing that you can do good and do well, and there's no excuse anymore. And so I think the more people can sort of share publicly in a way that private wealth and endowments can, and maybe institutional asset owners can't, that sort of transmission mechanism of information is no longer an issue where it was, I think, when we started a decade ago.
Yeah, that community of family offices, endowments, cards upping their work, showing that change is possible, certainly gives us a lot of work at the Institute, but also a lot of hope too. And Rasmus, the last word for you, hope.
Yeah, no, so my answer would overlap with the true previous remarks. I would say probably call it collective awareness, which connects to the prior answers. But I think if we just look at kind of the awareness around the challenges we're facing and what needs to happen, then I think just over the last 5 years, I think that has moved dramatically. And I can talk about it in also from a business perspective in an industry like the one I'm in. I think the collective or the general understanding of the challenges facing the built environment has moved substantially over the last 5 years. And we start to see kind of that the industry doesn't move fast enough, but the industry is moving, and call it institutional capital is moving, and so on. So we are moving in the right direction. I think we need to do it much, much faster and in a more absolute sense. But I feel the direction is right. We just need to speed it up and scale it up.
Well, on that note, it only remains for me to say a huge thank you to Kunle, Harry, and Rasmus for a really brilliant discussion where we're pushing the boundaries of impact investing. You should, at the de minimis, be 100% impact, and hopefully shifting in to those more challenging future-focused models that Harry and Rasmus are embodying. So thank you so much.